but you're also seeing a changing of the guard in the market right now. You're seeing that the value stocks are starting to outperform growth. You're starting to see that small cap has been outperforming large cap. You're also starting to see that emerging markets are outperforming the S&P, and also you're continuing to see global equities outperforming the S&P 500 at this point in time. And I think we got to pay a lot of attention to this because a lot of investors have been pulling the same playbook out when you had this declining interest rate environment, Frank, where you could say we could pay whatever multiple we want for these high-tech growth stocks. And at that point in time, you could do that. But now rates are starting to rise. And we actually think rates are going to continue to rise as you go through 2021. And we think you could see rates at the end of the year go to 150 to 175 on the 10-year, which I think is going to create some multiple compression and lead to, again, a changing of the guard. And we think a setback and then a correction. And Frank, I'd add one other thing in here, too. If you go back and you look at any sort of first year of a new presidential cycle, you have typically seen about a 5.8% return in a given year. But you also see a drawdown a little over 16% sometime during that year. That's the correction that we're looking for that we think ultimately should be bought.
All right, Craig, so the Russell so far has been the best performing index out of all of them, way up over the other ones. We just showed a chart just a second ago showing the Russell growth actually outperforming the Russell value stocks. So how would you explain that if you think that people should actually rotate their portfolio into value?
Yeah, you explain that, I think, this way. You're seeing money coming out of these large cap stocks. They're coming down cap. But also, if you think about what comprises the Russell 2000, it's dominated by the financial stocks. And as we're starting to see a steepening of the curve, the long end is backing up. You're actually seeing that 2 to 10 spread widen, which lifts all boats inside the financial sector. And that's really due to the composition of the index driving the small cap stocks at this point in time.
So, Craig, you sent us a note, and you pointed out that utilities, real estate, consumer staples, and communication services, they're all trading below their 50-day average. You mentioned that rising interest rate situation. How are they impacted by this technically? Do you see them breaking out or staying below that average?
I think they're going to stay below the average, and you know, we are actually underweight staples. We're underweight the utility sector, and we continue to, and also energy at this point. And we continue to think that based upon the relative strength work that we do here at Piper Sandler, that we want to stay underweight those areas, and we want to be overweight right now in this order: tech, industrials, and then also the consumer cyclicals. Financials are picking up in performance. And I think you're going to get an opportunity to buy some of these names, but it's a little early to buy them yet. Those are the three sectors we're overweight and underweight. And again, I think you're going to get this kind of healthy correction. The breadth thrust coming off of the March lows has been nothing but amazing, but you're getting to the point in time where you're at sort of historical extremes, not only on sentiment measures, breadth measures, and this is where you come back to the Warren Buffett line. You got to be fearful when people are greedy and greedy when people are fearful, and we're definitely not at the fearful point at this point when I look around at sentiment.
Craig, you know, I saw Wall Street. I thought greed was good, but on a serious note, we got to touch on one more sector. Energy, what's your take on that? Performing very well this year. We saw WTI hitting a recent high. What's your take?
I got to tell you, I've been doing calls since this publication came out yesterday. Most investors are not in energy. There's nobody there. It's a very small part of the overall S&P 500 right now. A lot of investors are just starting to think about rotating and selling some of the tech winners and buying some of the names in the industrials, but they're not even close to thinking about the energy names quite yet. I'm seeing a lot of amazing looking bottoms on the charts. Stocks like Devon that we've called out in some of our reports, and also Baker Hughes. You're making classic double bottoms, higher lows all over the place. I think people need to start putting their kind of big toe in the water here with some of these energy names because the charts look amazing. And it's not just one stock in there. I've got at least 15 or 16 stocks that look terrific on the chart basis.
Shepard Smith here. Thanks for watching CNBC on YouTube.